So you have a Sep IRA or you're thinking about one, but you really want to get more money on the Roth side. So how do you do it as a small business owner or independent contractor? We are going to go through a couple of scenarios, and I'm also going to point out a major change that, if you're not already aware, will help you maximize both your pre-tax and your after-tax dollars, which are your Roth side of your retirement plans. What's going on, guys? Welcome back to the channel, or if this is your first time at our channel, welcome to the channel. My name is Travis Sickle. So the Sep IRA and the Roth side, we're going to call it the Roth IRA, but it's not just going to be an IRA. We're also going to expand into a workplace plan. And you're going to see what I'm talking about. So let's start with the Sep IRA. Now, if you're not familiar, you can put up to $58,000 into the Sep IRA for 2021, but your income needs to be up there. Now, in order to get money into the Sep IRA, there is a formula depending on how you're filing your taxes. So this is what that formula looks like. If you're a Schedule C filer, it is going to be 20% of your net compensation or 25% of your W-2 if you're an S corporation or filing as an S corporation. Now, the Sep IRA is pre-tax only. So here is it's really important that you pay attention to this. You cannot make after-tax contributions to the Sep IRA similar to what you could do with a traditional IRA. Now, if you're not familiar, a traditional IRA is similar to the Sep IRA in that you can put in dollars pre-tax. So you're putting in pre-tax into the traditional IRA, but you also have the ability to do a non-deductible contribution, which are after-tax like the Roth side, but when they go into the traditional IRA as a non-deductible contribution, the growth after that is then deferred, but if it comes out of the traditional side, it is then taxed as ordinary income, the same as all the other dollars that are coming out of the traditional side. Now, the benefit of making the non-deductible contribution to the traditional IRA is the fact that you can do a Roth conversion. So you could take the money, put it immediately into the traditional IRA, and then convert it over to the Roth side of the retirement plans. But you can't do this with the Sep IRA. So how else can you get money into the Roth IRA while still having a Sep IRA? Well, simply, you could just make contributions into your Roth IRA up to $6,000 or an additional $1,000 if you're 50 or older, bringing that total contribution to $7,000. But that is not why you're watching this video. You want to know, what if you can't do that? What if you earn too much? So let's go ahead and take a look at what those contribution limits are, the phase outs, so you know how to plan to make sure that you're maximizing the Roth side and what else you can do if the Sep IRA can't get the deal done. And I'm gonna show you a little bit more why that's the case. So these are the income limits for the Roth IRA. And if you're married filing jointly at $198,000, or if you're single head of household at $125,000, and if you're married filing separately, forget about this strategy. $198 or $125 for single head of household, that is the beginning of the phase outs. So that means the amount that you can contribute directly into the Roth IRA decreases all the way down to zero when you get to either 208 or 140,000 for single and head of household. So once you get to these income phase outs, that's where you want to look at making the non-deductible contribution. But there's going to be a snafu that you're going to want to pay attention to that is really going to change the game for you. So here's what I'm talking about. So here's what this looks like. With the Sep IRA, we can make contributions directly into it, and that's what we went over before. And to get the money directly into the Roth, we can do that. But once we hit those income thresholds, then the only other option is to put money into the traditional IRA as a non-deductible contribution. So we put the money in as a non-deductible contribution, and then the idea is to do an immediate conversion, also known as a Roth conversion, and convert it over to the Roth IRA. But here is the big problem. In doing so, you're going to run into the pro rata rule. That means you need to take an equal amount from the non-deductible portion and the pre-tax portion. That includes all IRAs, so that's going to rope in the Sep IRA. That's a problem because the only way you're going to get that full contribution converted over is if you take 100% of your Sep IRA and also convert it, which will increase your tax bill and kind of defeats the purpose of what you're trying to accomplish because, again, there is no Roth side to the Sep IRA. So there's another way that you can do this. And this is only if you're over the income limits. If you're not, you can make that contribution directly into the Roth IRA. But even if you're below it, you might still want to do this strategy. So what is the strategy? We could take that Sep IRA and then we can roll it into a solo 401k because a solo 401k is not an IRA. So we are not subject to those same pro rata rules. So therefore, we could basically make the same exact contribution into the solo 401k. Plus, we're going to have the ability to make an additional $19,500. Plus, we can also have a Roth side to that solo 401k if you choose. But if you don't want to, that's okay too. You could still put the money into the solo side of your 401k and then max out your Roth contribution by doing the exact same strategy of a non-deductible contribution into the traditional IRA and then converting it. But the same thing you have to be aware of. If there is pre-tax dollars in your existing traditional IRA, those same pro rata rules are going to apply. So really, if you want more money or if you want this to be as easy as possible, if you're going to do the solo 401k, then you might as well also do the Roth side, which is a separate account that functions just like the Roth IRA. But the biggest difference here is now our contribution limits are up to $19,500 into that Roth side. And you can make an additional contribution by making non-deductible contributions into your traditional side of your 401k all the way up to $58,000. So you can really get a ton of money into the Roth side, and not to forget that you can also include your spouse for the exact same math. So you can almost double these contributions if your income allows for it, or if your income can be split between you and your spouse to maximize the amount that you're putting into the Roth side of your retirement accounts. And there are two things that you need to be aware of. These are really important. The first one is that big change that I talked about is the fact that you can open and fund a solo 401k up until your tax filing deadline, including extensions, which is exactly the same as the Sep IRA. In years past, that wasn't the case. That might be why you have a Sep IRA right now, because you're waiting until the last second, or you're waiting until you're just doing your books to know how much you can actually make in a contribution at the end of the year. So really, you can do that with the solo 401k, so that's a non-issue. The second point to be aware is that by making those contributions, you can do that for the previous tax year. But the conversions, if you're making those conversions, the conversions count in the year you do the conversion. So if you are waiting until the last second to make the contribution into your solo 401k or your Sep or any other retirement plan, and then you go ahead and do a conversion, conversions can't happen retroactively, where the contributions kind of can. So you can make that contribution, say, for 2021 for the 2020 tax year, but you can't do a conversion in 2021 and then count it for the previous year. So this offers a lot more flexibility in making your retirement planning contributions to choose between the traditional side and the Roth side. A lot more than we had in the past, and that was from the Secure Act of 2019. So that changed a whole bunch of things. They're actually just going into effect, and that's why this is really the first year that you can do the solo 401k up until tax filing deadline, including extensions, which opens up a lot of doors, not just for making those contributions, but giving you the leeway to get a lot more last minute into the Roth side. And one more point, the solo Roth side of the 401k, you can make that contribution directly. That is not a conversion. So you do have that ability just to put the money directly into the Roth side. But above and beyond that, it's going to be a non-deductible contribution. If you're hitting the income limits of $19,500, then above and beyond that, you can make a non-deductible, and that would count as a conversion. So a little bit of a nuance, I suppose, that you need to be aware of when you're making these contributions, but that's how you maximize your retirement plans, and you can choose which side that you want to make those contributions to. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.